Hello everyone. So today we are going to discuss now PT 365 of vision. Okay. So as we discussed today art and culture, now we are going to start with vision. Fiscal policy and inclusive growth. What do you understand by fiscal policy? Status of government finance. RBI released the state finance a study of the budget with coping with the pandemic. The third tier dimension, its annual assessment report on the state government finance. So consolidated gross fiscal deficit is 3.7% of the GDP and 4.7%. So combined debt to the GDP ratio is the 31% at the March, recommended by NK Singh committee. NK Singh committee ratio of the interest payment to revenue received increasing at a steady pace for last few years, including the erosion of debt and sustainability. So there is a debt erosion and sustainability is also not there. Market borrowings is the largest components of the outstanding debt, expressing 63% is the market borrowing. Okay, and we have the GDP debt to GDP ratio is the 31%. Debt to GDP ratio is 31%. Market borrowing is the 67%. Okay, and 15 to 25% revenue losses are there. So we can say national small saving funds and loans from bank for finance division and public account and total outstanding liability of the state have declining. वैसे small saving funds has been declined and loan from the government and financial institution also declined. But coping with the pandemic, third time dimension annual assessment report was there. State town tax revenue, tax income, tax property and the capital transaction, tax of the commodity and the services, dividend and the profit from the PSG, fee for the administration services, disaster relief grants and the grants for the local bodies. Revenue deficits also increasing, grant from the union government is increasing, non-tax revenue is a burden, tax revenue is also burden. Ensure the macroeconomic stability, keep the capital spending intact and employment generation, help to the overall economic growth, and ensure the debt sustainability. So what we want to do, low tax buoyancy. First of all, tax buoyancy should be low. Shortfall in the tax collection is there, so we should improve the tax collection. Reduction in the share of the united fund in central transfer to the states, so this should be better. Growing the cases and surcharge in the gross tax revenue, lower capital expenditure, and the populist programs such as farm loans waivers and the tepid performance of the power debt restructuring scheme, shrinking revenue of the outcome of the state. So increase the fiscal deficit, that is 4.1%. Increase in aggregate public debt of the state 25%, which is significant rise. 17% debt is increased. State town tax revenue is largest, like there is 45% total revenue received and 66.7% of GSDP is there. Lower property tax, like only 0.2% property tax is there compared to the sum of the developed country due to the factor like the property under revaluation. So incomplete property tax is also there. Strain on the state finance and the from state owned power distribution companies, DISCOM. So reform linked additional borrowing space, like central government permitted state to increase their fiscal deficit 3% and 5% GDP. 2% increase and increase in 1% GSDP was to permitted upon completion of reform in our area. One nation, one ration card, ease of doing business, urban local body, power distribution, special assistance to the state for the capital expenditure. Like under this scheme, state will provide interest-free loan for the 15,000 crore rupees prepaid by 50 years. So state will provide the interest-free loan to the 15,000 crore, and the 5,000 crore of the loans are earmarked for state which carry out the disinvestment of state public sector enterprises, a monetization, recycling infrastructure asset. Health sector is the 80,000 crore has been given to the state under National Health Mission. RBI is the certain relaxation are being permitted with regard to the available of the overdraft facility. VN mean advances limit for the state have been enhanced. So overdraft facility and VN mean advances also enhanced. So what balance of payment problems are there? Cyclic fluctuation, shortfall in export, rapid increase in population, structural change in the economy, natural calamity, international capital movement. What should be done? First, to reduce the inflation, lower the standard of living, short term, like increase the domestic production and employments, and the country could become a dependence on export driven growth, increase borrowing and the economic growth also. So government securities are Reserve Bank of India allowed the small retail investor to invest in government security by opening the gilt account. So there is some gilt account. So you can go for the gilt account for small retail investment, and the GSEC, which RBI retail direct scheme is there. A government security is a tradable instrument issued by the central government or the state government based on the time periods. GSEC are of two types. In India, the central government issue both the treasury bill and the bonds or dated security, while the state government issued bond or dated security, which are called the state development loans. So central government is issued the treasury bill and the bond dated security, and the state government state development bond. The acknowledge of the government debt obligation and partially carried out, no risk on default, and hence it's called the risk free giltage. So gilt account means a account open and maintained for the holding government security by an entity as person permitted by the Reserve Bank of India. So person residents outside India, the activity in the operation maintenance of the gilts are the Foreign Exchange Management Act and the regulation frame under the FEMA Act. Treasury bills are the money market instrument and short-term debt instrument issued by the Government of India and are presently issued by 3 tenure, namely 91, 182 and 364 days. Treasury bills are zero coupon security and pay no interest rate. So treasury bills are the three types: 91, 182 and 364 days. Treasury bills are zero coupon, is a zero coupon and there is no interest payment. Instead, they are issued at a discount and redeemed at the face value or at the maturity. So it will be redeemed at the face value at the maturity. So GSEC are the security which carry a fixed or the floating coupon and which is paid on the face value. GSEC is a security which carry a fixed or floating coupon and it's paid as a face value on the behalf of the basis. So generally the tenure of the dated security range from the 5 year to 40 year. Okay, so the treasury bills with original maturity of the less than 1 year, and the treasury bill with the original maturity of the 1 year or more. So dated securities are the security which carry a fixed or floating coupon which is paid on the face value or half yearly basis. So this is the face value on half yearly basis. Generally the tenure of the dated security range from the 5 to 40 years. So dated security is a fixed floating coupon which is paid on the face value on the half year basis. This is based on the half yearly basis in the face value. Benefit of GSEC. GSEC can be sold easily in the secondary market to meet the cash requirement and can be used the collateral to borrow funds in the market. An attractive yield will be there, and GSEC such as SDL, Special Security, Oil Bond, Uday Bond, and help to RBI to manage the liquidity in the market in the open market operation, offer the maximum safety and carry the sovereign commitment and the risk-free investor-friendly settlement system by using the delivery versus payment. Delivery versus payment is the risk-free payment system. Simultaneously transfer of security by the seller and the fund transfer from the buyer. So flexible investment option is investors through the wide range of maturity. Here is the wide range of maturity, 91 days to 40 days. Now next one is the bond yield. What is the bond yield? So bond yield, major risk of the holding the GSEC is liquidity risk, inability of an investor to liquidate his holding due to the no buyer. If there is no buyer, then how he will liquidate his securities? Market risk due to the adverse movement of prices of the security of the bond yield. Reinvestment risk, like flow of the GSEC include coupon every half year and repayment of principal of maturity. The cash flow are required to be reinvested whether they are paid, leading to situation reinvestment at a lower yield and prevented later. So what kind of risk are there? First is the liquidity risk, second is the market risk, third is the reinvestment risk. Three type of risk are with the GSEC. But bond yield is what? Fall in price bond, then yield will rise in interest rate. First is if there is the fall in the price, then rise in the interest rates will be rise, and speculation of economic recovery will be there, rise in inflation. If price is falling, then inflation can be rise, can increase due to this all, and can lead to bond yield can be increased if price is falling, then bond yield will be increased. If inflation is rise, bond yield will be increased. If speculation of economic recovery, then bold yield increase. If rise in the interest rate, coupon rate, then bold yield will be increased. So this is price. If falling the price, it's inverse relationship between the bond yield. But the making equity investment unattractive. If there is a equity is unattractive, then bold yield will be decreased. Rise in the cost of capital. Like if falling in the price, bold yield will be increased. But if rise in the price, then bold yield decrease. And rise in the volatility of the economy. In volatility, bold yield decrease. Okay, so issuing the authority RBI. RBI is a consultation with the government of India, and issuing platform is eKuber, core banking solution platform of RBI with the GSEC auctions. So eKuber member including non-scheduled urban cooperative banks can participate in the primary auction through the scheduled commercial bank and primary dealer called the primary member. So clearing the agency Clearing Corporation of India Limited act as a central country party and act as a seller to the buyer and a buyer to the seller for the actual transactions. So recent initiative regarding the GSECs and their impact potential is initiative RBI Retail Direct Scheme for the individual investor to bid in the primary auction and buy and sell of government bonds. So GSEC and SDL and the sovereign gold bonds, no fee will be charged for any of the service provided under this scheme. Government security acquisition program is from the RBI will aim to purchase government security worth 1 lakh crore in the quarter of 5-year plan, and long-term repo operations also there. Long-term repo operation will RBI to provide 1 year to 3 year money to bank at the prevailing repo rate accepting the government security with matching or higher tenure. And operation twist is the RBI inverse relationship with the bond price and yield. Bond purchase and RBI bond pushes price upward and the yield come down. So what is the initiative versus primary auctions and the buy and the sale of government bond? Then bond is a GSEC and SDL sovereign gold bond. No fee will be charged on that. Government security acquisition program, SAFE program is there. This SAFE program, security acquisition program, is up to 1 lakh crore rupees is first quarter. Long-term repo operation, prevailing repo rates accepting government security with the matching higher tenures, and operation twist, inverse relationship between the bond price and the yield. So there is the inverse relationship. Bond purchase from the RBI pushes the price upward and the yield come down. Now broaden investors base with the additional investment avenue for the retail. So if we want to broaden our investment base with the additional investment avenue, then finalizing the domestic saving will be increased. But unlike small saving scheme of the union government such as the public provident fund and national saving certificates, there are no specific tax benefits or direct purchase of the government bond, but it will be financial stability and the prevent the crowding out effect, and the yield of act as a fillip for the equity market. Provide the longer duration fund for the bank as compared to the short term liquidity by liquidity adjustment facility and the marginal trading facility. 1 year and 3 year long to the bank at the interest rate similar to the overnight repo also. So lower the long term yield will make the saving less desirable due to the lower interest rates and boost the economy by making the home vehicle and less expensive. So government security GSEC to soon join the global bond indices. Global bond indices include the investment grade and the government bond from the around the world with maturity greater than 1 year. So global bond index is the bond index whereas the maturity is the more than 1 year. GSEC is a tradable instrument issued by the central and state government. It acknowledges government debt obligation. GSEC is a tradable instrument issued by the central and the state government. So it's a acknowledged government debt obligation. GSEC carry particularly no risk of the defaults and hence called the risk-free gilt-edge instrument. GSEC government securities are the risk-free. It's a risk-free gilt-edge instrument. Benefits of the joining the global bond indices is attract the foreign inflow in the debt market, reducing the pressure on the commercial bank to absorb the government bonds and build the goodwill of the for the Indian bonds market. So what is the benefits of the Indian global bond indices? Debt market, reducing the pressure on the commercial bank to absorb the government bonds and build the goodwill of the Indian bond market, give the strength and stability and help to the government in the market borrowing also. So ownership of the Indian government bond across the countries are foreign investments are the 1.9%, commercial banks are 38%, insurance are the 25%, Reserve Bank have the 60%, EPFO 4%, cooperative bank 2%, foreign investor 1%. So commercial bank, then insurance, then Reserve Bank of India. Commercial bank, then insurance, then Reserve Bank of India. So this graph should be in the mind. Now taxation is what? Retrospective taxation. Taxation law to amend the Income Tax Act and Finance Act. Scrapping the 2002 is retrospective tax law. What is the retrospective tax law? It's a backward looking tax used by the nation to remove taxation anomaly through new and additional charge of the past transaction to overcome the misuse of legal loopholes of company. So it allows a country to pass a rule on the taxing certain products, items or service that deal with the charge company from a time behind the date on which law is passed. In India, it was introduced empowering income tax department to raise tax demands on the capital gains arising from the indirect transfer of asset in the India. So this is the backward looking tax used by the nation to remove the taxation anomalies. What are the taxation anomaly? We want to remove that, and the new or additional charge of the past transaction to overcome the misuse of legal loopholes. So is allowed to the pass the rule of taxing certain products, items or service deal with the charge companies from a time behind the date on which its law passed. So right to tax is a core sovereign power, and the Constitution of India empowered government to levy a charge tax except by the authority of law. So through the upheld the investor state dispute settlement as well as bilateral investment treaty BIT, certain limits of right as expropriation is a no confiscation of claim on the property against the owner wishes from the government. Fair and equitable treatment take should be not be discriminatory. India framed the BIT excluding taxation measures from the scopes and reducing the ISDS to interfere in sovereign right of tax. So Section 9 of the IT Act to nullify the demands raised by the indirect transfer of Indian assets made the 28 May fulfillment of a specific condition like the withdrawal of appeal petition, arbitration in the disregard, refund of the any amounts paid to these are without Section 244A. However, offshore transaction involving India's asset executed after the 28th May and still taxable as there is no retrospective application. So leads to the transparent, stable, predictable taxation regime. Transferable, stable and predictable taxation regime sending a positive signals to the investors on the ability to India to sort out the legacy issues and improve the investment or a stable operating environment and help in the early recovery of the COVID-19. Increase the tax base, higher growth and the work for the opportunity. Global minimum corporate taxation. What is the global minimum corporate tax rate? Recently, Organization for the Economic Cooperation and Development had released a two-pillar model ruled by domestic implementation of 15% global minimum tax. So part of the inclusive framework of the base erosion profit shifting agreed to the G20 countries and OECD. It's a base erosion profit shifting is to tax planning strategy. Exploit gap and mismatch is the tax rule to artificially shift profit to lower non-tax location where there is a little or no economic activity resulting little or no overall corporate tax bed. So the global minimum corporate tax required company to impose a minimum tax at a large multilateral company to counter efforts by which it escape the tax into the country operations. So MNC with the revenue about 750 million and aim to developing a taxation structure that is relevant for the digital globalized world. Amazon, Google, who will be the forced to pay tax to country based on where these goods and services are sold, regardless of whether they have a physical presence in the nation. Suppose a company headquartered country A is reporting country B where it is 11%. With a global minimum rate 15%, country A would top up the tax and collect the 4% of the company profit from the B, representing the difference between the country B and the global minimum rate. So OECD has a two pillar. First is base erosion, patient shifting, collaborating to put the end to the tax avoidance, and the two pillar is the domestic implementation 15% global minimum tax by reforming the international taxation rule, ensure the multinational enterprises pay a fair share of the tax whether they are operate, include the globe rules with the globe rules to make part of the domestic legislations. Globe rule provide the taxation system to ensure the MNC pays a minimum level of tax on the income arising and jurisdiction operates. So rule will be the create a top-up tax to applied on the profit in any jurisdiction whether the effective tax rate is below minimum 15%. According to experts, India is likely to benefit the effective domestic tax rates in above a threshold, and country would continue to attract the investment. Removal of existing digital service tax and other unilateral measures such as the equalization levy introduced in 2016. Large India headquarters MNC may also need to comply with the pillar, and India will need to share its taxing rights. Other country and India could be the losing revenue from other not so digitalized company. Direct monetizations of the fiscal deficit. There is a debate whether India should be under the direct monetizations of the fiscal deficit by Reserve Bank of India. So, given the hurt to economic caused by COVID-19, fiscal deficit is the government expenditure exit income due to lower tax collection, increase the expenditure to mitigate the fallouts of pandemic. India recorded fiscal deficit 9.3% of GDP, and it put 6.8% of GDP. To finance this fiscal deficit, number of options available in the government. Direct monetization refer to the scenario central bank prints currency to tune of accommodating massive deficit spending. And second is the RBI purchase the government bonds in the primary market, increasing money supply in the system. It may not necessarily involve the actual printing of the currency, as the central bank could simply credit the government account through electronic accounting. Helicopter money, where the large sum of the new money are printed to stimulate the economy during the crisis like recession. So, financing the fiscal deficit, first is monetizations of the fiscal deficit, printing new currency. Second, indirect monetization undertaken through the open market operations, and RBI is the bond from the secondary market by printing fresh currency. Direct monetization is the government bonds are primary market by printing money to finance the spending needs of the government. In interest debt is the borrowing within the country. External debt is the borrowing outside the country, and incurred debt is the borrowing from the capital market by issuing different instruments like the treasury bills and the bond. Now next one is direct investigation of the deficit India. Automatic monetization of the deficit through ad hoc treasury bill. Way and means advances replace ad hoc treasury bill. Ad hoc treasury bill is replaced by the way and means allowances. Automatic monetizations of the deficit ad hoc treasury bill complete the prohibition of direct monetization FRBM Act, and direct monetization law under the FRBM Act amendment of through escape clause. Now, financing the extraordinary recovery program from the government through direct liquidity, mitigating the deflation and stimulating moderation inflation, maintaining financial stability, and increase the interest rate and government borrowing cost if large deficits, and finance to issue GSEC, infuse the liquidity in the financial system, interest rate cut and not possible inflationary concerns. Other benefits, no increase in future tax burden, and it can be reduce the value of the government outstanding obligation to some extent is increasing the inflation. So high inflation is there, we can let the hyperinflation Zimbabwe with the many percent erode the credibility of the RBI and its ability to fulfill its mandate by removing the barriers between the monetary and the fiscal policy. Hurt the fiscal prudence by disincentivizing the fiscal consolidations, ineffective to increase the liquidity as the money extended by the fiscal program inevitable end up to the banking system, increasing bank reserve RBI due to the reluctance from the bank to the lend. Now, depreciation of the currency due to supply-demand imbalance. RBI could step in and intervene using this forex reserve. However, running down the forex reserve is ultimately a balance of payment crisis. National monetization pipeline. What is the national monetization pipeline? It's a roadmap for the assets, the asset monetization, various brownfield investment, various brownfield. It's a monetization. If a national infrastructure pipeline, then there will be both brownfield and greenfield. But this is the national monetization pipeline. There's only brownfield, not the greenfield. Okay. So also refer to the asset capital recycling. And asset monetization is process of conversion asset into the economic value. Offering the public infrastructure to private sector also. Non-debt capital institutional investment serve three critical objectives: unlock the value of the public investment, tap the private sector efficiency, and create the new sources of the revenue. Unlocking the value hitherto underutilized public assets. So difference from the dismanagement of the government remain owner. Brownfield infrastructure assets are language not fully monetized or transferred for the limited period, unlock the capital. Funds so received by the public authority help government to reinvest. Then other assets are projects including the social sector and the competing the public priorities. So it's helped the generating the more returns from the assets into the higher operating efficiency and enhance the user experience offered by the private sector entity. First is new infrastructure will be create, existing asset will be existing base will be create, monetization existing assets, proceeds from the monetization new infrastructure. Key sector of this identify this. The top 5 sectors are the 83% of the aggregate pipeline value. These include the roadways, railway, power, oil and gas pipeline, telecom. Monetization of the assets are the identified the one of the 3 pillar. Enhance the sustainable infrastructure. According to National Monetization Pipeline has been planned to co-terminus with the National Infrastructure Pipeline and help to evolving the common framework for the monetization of core assets. So monetization through the disinvestment, monetization non-core asset and the being included core and non-core. So asset which are central in the business objective of an entity and are used for the delivering the infrastructure service to the public user by considering the core assets. Other assets are which generate include the parcel of building can be categorized non-core assets. So total indicative values are core assets are the 6 lakh crore and the 4 periods. Corresponding 5.4% of total infrastructure investments are the National Infrastructure Pipeline 111 lakh crore and 14% of proposed outlay is the 43 crore. So monetization of right not ownership, so handing back to the assets transfer like brownfield de-risk asset will stable revenue generation and critical importance. Structuring the partnership under the defined contractual framework, transparent competitive bidding will be there. Key performance indicator and the performance standards, so assess the transactions identified under the expected to be rolled out the range of the instrument. Asset monetizations are the brownfield obliged to the provide the remains of the public authority, but the day-to-day management also asset design the build, finance, operate, transfer. A proposed private participation will be there. Operate the maintain the development adopted by the airport India. It adopted the toll operated transfer roads, operation maintenance, design, build and the finance, operate, transfer. A proposed private participation will be there. Operate, maintain and develop adopt into the airport. And structural finance are the long-term lease like can be adopted the case of the sector such as the telecom where the license to provide an infrastructure service already available. Infrastructure investment trust in which is also in this infrastructure assets will be created pull to the money from the diverse sectors and the real estate investment trust will be there, so projects are eligible for this structure. Now land bank, what is the concept of land bank? So DIPAM, Department of Investment and Public Asset Management, is structured the land bank company with the task of selling land parcels owned by government department and public sector companies. So land bank is a government entity to non-profit corporation to manage the dispose of vacant property, vacant lands and tax delinquent property to ensure more productive vacant land. So this is a NGO land bank which is the managed by dispose of vacant property. Started 1990. Most of Indian states are already sizable land bank. Where is the process creating Niti Aayog strategy for the New India 75 suggested new system using the geographical indications based map for the pre-approved land bank. So they improve the land use efficiency. 2.54% of total area, we have the 18% population. Addressing the delay in the disposal government land, lack of the single comprehensive database of the land. So we encroachment also boost the economic growth, strengthening 29.6% contribution from land to economic growth, boost the investment and the stop solution to free easy accessible of the related industrial information, ease of doing business and the transparency will be increased. So right to fair compensation, transparency and land acquisition rehabilitation resettlement act was there 2013. It was Land Acquisition Act of 1894 where the social impact assessment will study the estimate cost and benefit to people affected through the acquisition, and it's mandatory for the whole project in the cases of urgency for the irrigation projects, for the environmental assessment and rehabilitation and resettlements of the lands. So compensation will be provided to them and stipulate the mandatory consent 80% of the 70% landowner acquisitions, public-private partnership project, 80% of the acquiring land will be the private company. Now these are the land bank. Land bank are the GIS system. Land bank system is a GIS based system where the six states are faced. So Indian Industrial Land Bank portal is the 3350 industrial areas cluster. 47500 hectare land will be there. Aims to provide the following information available to the land and prospective investment GIS mapping of the industrial cluster, link to the GIS portal and state land bank, information about the existing external and internal infrastructure such as road, railway and the connectivity. This investment is reducing the fiscal burden, improving the public finance, and the government want to move to the non-essential service. So to encourage the investment, to improve the efficiency and productivity, to encourage the domain expert, and to induce the competitions, reduction in the fiscal deficit, better management, introduction of best practices, improve the investment sentiment and the investment, less government and more governance, improve the efficiency, improve the service and the greater responsiveness. So what is the inclusive growth? See, inclusive growth is the Niti Aayog and National Multidimensional Poverty Index Baseline Reports Dashboard, UNDP and Oxford Poverty is OPHI, which is like end the injustice, poverty, inequality and climate change, critical role of the country's sustainable development, demographic governance, peace building, climate and disaster resilience. What are the problem? Poverty, low demand, saving population, regional inequality, climate change, high literacy, overarching on the agriculture, high output packet expenditure, low investment, low income, food insecurity, substandard living conditions, health issue and the poor academic architecture. Nutrition is adult, 70 years of age is the child or whom there is the nutritional information is undernourished, and child mortality, any adult under the age of 18 who have the family is the 5 year, which is the child mortality. Year of schooling, no household member age school entrance to the 6th year of the old is completed the 6th year of the schooling. School attendance, any school age of the child in the not attending the school up to the age of the would be complete the class 8. Cooking fuel is the household cook with the dung and the wood and charcoal. Sanitation is important facility not improved and it's improved shared with the households. Drinking water is there like sustainable development goal, so providing the drinking water, housing, electricity and asset. What is the multidimensional poverty index? So it's UNDP and the poverty estimates used to the UNDP flagship human development report. Head count of the incidents are MPCI based on the 3 macro dimensions. One is the health, second is education, third is life of standard of living, covering 10 indicators. Acute deprivation, we going for the MPI value and that 0 to 1 value is there. Third or more than 10 weightage indicator, global MPI indicate the MPI poor. So multidimensional poverty, head count, intensity of the poverty, say unmarking disparity by the ethnicity, caste and gender. India was ranked 62 out of 109 nations and 0.123 multidimensionally poor. For the first time, global multidimensional poverty index disaggregate ethnicity and race by caste by gender. So top 5 countries is the India, Nigeria, Pakistan, Ethiopia and the Democratic Republic of Congo. National Multidimensional Poverty Index was the Niti Aayog, part of the global indices for the reform of the growth increase. The latest index is based on the MPI from the UNDP and this the major difference is global MPI inclusion of 2 additional indicators: antenatal care, bank account, health and standard of living. National Family Health Survey was there where they provided this nutrition, child adolescent mortality, antenatal care, health, education and standard of living. For health, year of schooling to 10 year up to class 8. For the standard of living, cooking fuel will be there, sanitation, drinking water, electricity, housing, asset and bank account. So this is National Multidimensional Poverty Headcount Ratio Intensity is the UT districts and the major finding. National Multidimensional Poverty rural is the 1.1555 and urban is the 0.04. So the highest poverty is there. Bihar is the 51% populations are poor and Jharkhand and Uttar Pradesh, and lowest poverty is state is Kerala. So Bihar is the highestly poor and the lowest poor is the Kerala. Okay, and Puducherry and Lakshadweep. So in the Dada by Noroji is the book The Poverty and British Rule of India is the mad first attempt to define the poverty. National Planning Committee was a Bombay plan defined poverty line. Post independence, the Planning Commission working the Radenkar Rath Formula, Alak Committee and the Lakadwala Committee, Tendulkar Committee and Raghunajan Committee. Financial inclusion is what? Assess the financial institution, low cost financial product, agent banking, document simplification, increasing the technology, reducing the extra poverty, better targeting beneficiary, inculcate the habit of saving, increase the capital formation, reduction in the cash economy, and assess the formal credit. So RBI is the Composite Financial Inclusion Index, which was governed by the RBI. So comprehensive index to capture the extent of financial inclusion. Recommendation by the RBI under the National Strategy for Financial Inclusion incorporate the retail of banking, investment, insurance, postal as well as pension sector, and capture the information of various aspects of the financial inclusion. 0 to 100. 0 represent the complete financial exclusion and 100 for the inclusion. Three broad parameters are there: certain, uses, and the equality. Assess, user, and quality. What is the assess, user, and quality? FI index doesn't have the base year, like financial inclusion doesn't have the base year is not there. Banking branches, number of ATM, corresponding sales, credit, insurance, remittance, frequency of account opening, financial literacy, consumers protection, inequality and deficiency, grievance redressal. RBI National Strategy for the Financial Inclusion to expand the sustain the financial inclusion process at the rational level through the broad convergence of the action involve all the stakeholder. National Strategy for the Financial Education were enabling various sections of the population to develop the knowledge, skill, attitude, behavior, and the by government Pradhan Mantri Jeevan Jyoti Yojana for the people of the age 18 to 15 year has the banking of Pradhan Mantri Suraksha Bima Yojana 18 to 17, Jeevan Jyoti Yojana is the 15 and the Suraksha Bima is the 17. Atal Pension Yojana is it's a pension Yojana, that's why age limit is less 18 to 40. Pradhan Mantri Jan Dhan Yojana, that is ensure the access financial service affordable manner. To ensure the various financial service need-based credit, insurance and pension to excluded the service weaker section, low income group. Use of the technology to the reach the financial sector. Pradhan Mantri Jan Dhan Yojana, universal access to banking account, credit guarantee fund, financial literacy, microfinance, pension and the basic saving account will be there with the overdraft facility. 43 crore account opened and the 85% accounts are operative. 2/3 of the account in the rural and semi-urban. 5 crore account holders receiving direct benefit transfer from the government under the various scheme deposits under the account. Jandan Darshak app is there, which is citizen centric for the location of banking touch point, branches, ATM, bank mitra, post office, and the lack of branches to map the GIS application used for the identification of the village which are not served by the banking touch point. Now, key corporate of the information of the fiscal policy is debt to GDP ratio. So, the debt to GDP ratio it indicates the country ability to pay the debt. So, fiscal responsibility in the Budget Management Act mandate debt to GDP ratio is the 40%, and it's a 20% for the states and 40% for the center. 40 and 20. Okay, and fiscal deficit is the 6.8% of GDP. High capital expenditure, low revenue realization, low revenue expenditure, unprecedented COVID-19 economic growth is and demand curve, crowding of effect in investment, debt accumulation, higher inflation. These are some reasons of the fiscal deficit. Fiscal deficit is the total expenditure minus total income of the government. So there will be the capital and revenue expenditure and revenue receipt and the revenue loans and the other receipt will be there in the expenditure. Now, strategic and non-strategic bifurcation. Strategic is like banking, insurance, financial service, power, petroleum, coal and other minerals, and the atomic energy, space and defense, and the transport and the telecommunication. So these are the strategic sector, which are the power, coal, mineral, transport sector, atomic energy, space, defense and banking, insurance sector. So guideline for the central public sector enterprises disinvestment released by the Ministry of Finance to guidance privatization, merger, closure, subsidization of the non-strategic to implement the new strategic policy. Main objective: reduce the financial burden on the government, introduce the competition market and discipline, encourage the wider share. ITAT E-Dwar. ITAT E-Dwar is a portal for the tax appellate tribunal. ITAT is the Ministry of Law, will accessibility, accountability, transparency in the tax economy. It's the Ministry of Law. Okay, it's the ITAT, which is a use the paper saying post rationalization of the fixation cases. Place of effective management. POEM. POEM is a business for the family individual. COVID-19 risk is there, so the under section 6 of IT Act, POEM is defined a place where by key management and commercial decision that are necessary for the conduct a business of the entity wall of the substance made to curb the practice of limiting the scope for the Indian tax authority by artificially shift insignificance related to the control and management outside India to avoid residential instances. Now supplemental of Y grant, so the additional grant required to meet the required expenditure of the government is called the supplementary grant. This grant mentioned under the Article 115. So supplementary grants are the additional grant required to meet the required expenditure of the government is called the supplementary grant. This grant mentioned 115 article. Gini coefficient is the popular tool for the Indian distribution inequality globally. Lorenz curve is the geographical curve to this inequality and intimately related to Gini coefficients. So 0 is for the perfect equality and 1 for the inequality, and this is showing the a curve of the Gini coefficient A upon A plus B. Next is the K-shaped recovery. When different section of economy recover at the starkly different rates, like if there is a different rates in the recovery, not a similar rate, it's a different rate in a recovery. So the real estate sector say K-shaped recovery, where the residential segment experience healthy growth, and the observed in the job market lower risk worker lose their job, and disproportionately why job loss aren't significant for officer worker in financial sector and service sector. So different sectors are representing different way. Now first is economic recovery but actively permanently lost. If there is a permanently lost, then this will be the V-shaped recovery. Recovery slower than V-shape. U-shaped recovery is slower than the V-shaped recovery. Okay, so economic recovery but actively permanently lost. So that is V-shaped recovery is lower than V-shape is the U-shaped recovery. Recovery longer than V-shape, faster than U-shape is the different kind of shape. This L type of shape. Standing surge fuel GDP above per crisis level. So there is the GDP per crisis level is the Z-shaped recovery. Restriction lifted to the GDP, further the more cases of the paralysis of the economy. So this is the paralysis of the economy. Okay, an economic never fully recover. If there is no fully recover, that is this. And recovery industry technology and the retail software industry. So we can see this is the recovery. Okay, an industrial needed to assistant travel, international hospitality and the food service. Now banking and monetary policy. What do you understand by banking and monetary policy? The privatization of the public sector bank. Recently, the financial secretary said that government will eventually privatize the most of the public sector banks. Presence of bare minimum. Better human resource management, improve the competitiveness, promote the innovation, expertise, and improve the asset quality and the efficiency of the debt coverage. Attract the urban and semi-urban consumer. Financial exclusion of the weaker section will be reduced. So financial inclusion of these sectors and the reduce the employment opportunity will be reduced. Now employment will be more approved. Concern safety deposit sovereign guarantee. So domestically systematic important banks are too big to fail by RBI due to their size, cross jurisdiction activity complexity and the lack of substitute of interconnection. So bank would whose assets are 2% of GDP considered the part of this bank. SBI, ICICI Bank, HDFC continue to remain the these banks. As per the framework from the central bank has to disclose name of the bank, design of this. The credit growth. So enhance the assets and the service excellence, like a reform in the agenda, ease of doing business, agenda of the customer centric, digital transformation, deeply embed digital and data. Now it's a loan 59 minutes, trade receivable accounts, trades will be digital lending to MSME. Trades are going to give the digital access to the MSME. Empowerment of the bank of board, chief risk of officer, market linked to the compensation. 3.17 crore government mobilizations of the banks also there. Decreasing in the savings, so we want to increase the saving. Bad loans and the limited corporate investment is there, and degrowthing is also there. Credit rationing is wanted. Financial deepening and the resources from the seaward borrower and produce investment opportunity. positive investment and supports to small business in the operational liability, greater access to the institutional credit. Prompt corrective action. How do you understand by the prompt corrective action? So this is enable the supervisory intervention to maintain a overall financial health and regulator, investor and depositor to check high risk lending and effective market intervention for the checking the non-performing assets also NPM. So RBI issued the revised norm for the commercial bank that are to place under the prompt corrective action. RBI has also issued the prompt corrective action framework for the non-banking financial company to tighten the regulation of weaker sections. So it's a cover the deposit taking NBFC excluding government company non-deposits taking NBFC upper top layer core investment banking NBFC not accepting not intending to accept the public fund government companies primary dealer and housing and the financial company. Prompt corrective action is a framework under the financial institution usually bank not the whale. So weak financial metrics are put under this. So first introduce is structure the early intervention mechanism for the bank that become the undercapitalized due to the poor asset quality vulnerable due to the loss of profitability. Review the best of the recommendation financial stability and the development council and the financial sector legislation reform. Prompt corrective actions the parameter capital asset quality monitoring under revised framework. Three risks are there, so remove the returns assets and indicator and all operating India including the financial bank and branches subsidized bank are there also. So prompt corrective action is the audited annual financial results and ongoing supervisory assessment by the RBI. Supervisory comfort of RBI, no breaches of risk and parameter for continue quarterly financial statements, audited annual financial assessment also. Risk threshold is the strategy related, government related, capital related, credit related, market related, HR related. Lots of risk are there. Risk one is the dividend distribution risk, okay, and capital risk other taking the contingent liabilities. Risk threshold 2 is the restriction of the branch expansions. Risk third is the appropriate restriction of the capital expenditures and technological upgradations. Variable operation costs are there. So prompt corrective action are the bank allowed to invest in the government securities and high quality liquid investment will be there. So NBFCs are the non-bank financial institution entity that provide a certain bank like and the financial service but do not hold any banking license. There is a no banking license and exclude entity with the agriculture activity industry purchase or sale of goods as a principal business providing any service and sale purchase construction of immovable property. So there is no agriculture, no industry, no purchase of sale any goods and as a principal business, what is the principal business? Providing the service to the immovable property which is not movable. So principal business is financial activity is the 50% of the company asset and 50% gross income. NBFCs differ from the bank because NBFC cannot accept the demand deposit, not part of the payment settlement system, can't issue the check drawn on itself and CIGC facility is not available to the depositor and NBFC. Regulation of NBFC are the regulated by the RBI, although some NBFC can regulated by the SEBI and the IRDA and National Housing Bank to avoid the dual regulations. But systematically important NBFC are whose asset size are 500 crore or more is considered to be systematically important for Power Finance Corporation, rural electrification and this all. Now capital to risk weighted assets ratios are 300 below the regulatory and CR are 12%. Tier 1 is the 10% and up to 200 below the regulatory and non-performing assets are 9% and 12%. Risk thresholds are the 600 or below regulatory CRR, more than 400 BPS below the regulatories and more than 300 to 600 regulatories are there. Okay, so what are the regulation of NBFC revised in the scale-based regulator framework? Recently, RBI has introduced the revised scale-based regulatory framework for non-banking financial companies. Under the revised regulatory framework, they will be subjected to the scale-based regulatory framework with 4 layers of the activity. So this is base layer is the NBFC 1000 crore, and activities are lending, accounting, aggregating, non-operating financial holding company, NBFC not availing for the public funds and customer interference. Middle layer is the 1000 crore or more, standardizing the primary dealers, infrastructure funds, housing finance and the infrastructure finance company. Upper layer is the third layer, which is the RBI warranting to enhance the regulatory framework. Top layer is the ideally remain the empty, but RBI can populate if the substantial increase in the potential risk. Extra NPA classifications are given. Ceiling is the 1 crore per borrower in the IPO, and at least one director will be there for this. So top layer will be the supervisory direction, about 25 to 30. Upper layer will be there, so the lifting process equivalent to NBFC and the equivalent to the, but with the threshold of 1000 crore. So base layer will be there, middle layer and upper layer of top layer. So new category will be the bank like regulations and the arbitration and plugs. So capital guidance will be there, and the governance guidance for the prudential guidance for the credit concentration. Now we are going to discuss about the payment bank. What do you understand by the payment bank? So significance of payment bank is towards the financial inclusion, risk minimization of GSEC, geographical footprint of 25% is mandatory for the unbanked area, provide the microcredits and increase the penetration of the technology. So RBI is a schedule bank that state to number of the payment banks for the payment bank and the Airtel payment bank. Schedule bank are the bank include the second schedule of the RBI. This include the schedule commercial bank and schedule cooperative bank. Request, so schedule bank requested to the RBI for open a primary actions and fixed rate, variable repo rates and reverse repo rates are there. They can be like marginal trading facility will be the eligible to partner to the government run financial inclusion scheme, but they are eligible for the refinancing a facility in the RBI, and bank rates required to membership to clearing houses, access to the currency storage also. So these are the system of the bank, scheduled commercial bank. But in the payment bank, what suggested Nachiket More committee was there, and it's for the like payment is the More. Nachiket More Company Act is the 2013 license under the Banking Regulation Act. Minimum paid up capital was at 100 crore. What is it's 100 crore, not 1000 crore, 100 crore only, and the capital adequacy ratio is the 15% in the payment bank. Promoter of the payment bank and should be the 40% of paid up capital in the 5 year. Promoter of the joint venture will be there, and the operate on the smaller scale with no risk will be there, and accept the demand deposit, offer the remittance is accept the demand deposits, yes, 1 lakh crore. Its remittance are also provided. Payment transfer purchase will be there. So NBFC do not accept the demand deposit as we upper. These are the and this is prompt corrective action. Now we read about the prompt corrective action. Now payment bank are there with no credit risk and accept the demand deposit up to 1 lakh and offer the remittance service, mobile payment transfer purchase, also maintain the cash reserve ratio with the RBI and invest in the eligible government securities. Statutory liquidity ratio also maintain. Interbank and collateral call money markets are the collateralized repo, and the CBLO market will be provided. SEBI allow the payment bank to act as an investment banker and work a raising capital for the corporation, government and the entity. Goldman Sachs and the Morgans. Now deposit insurance and credit guarantee corporation. What is this? Deposit Insurance Credit Guarantee Corporation. Deposit Insurance Credit Guarantee Corporation amendment was in the news. It's a wholly owned by RBI, created by this with the Deputy Governor of RBI. So provision is to this is regulations of 1961 liable to pay the issue deposit amount to the depositor in an insurance bank. It registered a bank as a insured immediate and automatically issuance of the banking license. For all issuance bank, payment of the deposit insurance is a compulsory pay for the issuance and amount of the issuance like liquidations, reconstructions and the merger and acquisition. Liquidation means sale of the assets, reconstruction means other arrangement and the scheme, merger means the another bank. It covers the all commercial banks including the payment bank, small saving bank, regional rural bank, bank branch, local area bank, cooperative bank in all states and union territory. In the large budget, the deposit insurance cover bank is the 1 lakh and the 5 lakh per deposits per bank fully by 98% of the total 256 crore will be there. 50.9% total accessible deposit as internationally fully protected account are around 80% and 20% acceptable deposits. Bank group wise percentage of insurance deposit also there. 70% of cooperative bank, 50% of RBS, 59% SBI, 55% PSB and 40% of private sector bank are the 9% of the foreign bank. So what is the feature of this? It's the introduction of interim payment bank. These deposited 19 days timeline, providing the penal interest of the case delay to the ensure the timely repayment of the bank, removal of earlier ceilings and payments for the ceilings. Now empower the boards for the repayment of the money. Now asset quality and the restructuring. What is the insolvency and the bankruptcy codes? Parliament passed the Insolvency and Bankruptcy Code in 2021. It's a package insolvency and the resolution process of the corporate MSME. So this is the resolution to state assets, company, limited liability partnership, proprietorships, partnership firms. So it's covered 5 years for the operation. It has created insolvency system, National Company Law Tribunal to a pre-packaged insolvency solution agreed upon the between distressed corporate debtors, lenders approaching to the National Company Law Tribunals for the bankruptcy debtor in possession model. Its legal sanction to the plans agreed upon the bank. It also protect the fraudulent activity mismanagement, allowing the committee of creditor to make an application for the change in management and financial creditor to corporate debtor or the operational creditor in the absence of unrelated financial creditor. It allows the swift challenge to resolution plan and allow to third party submit resolution plan in case of operational creditor not paid 100%. Insolvency professional and the insolvency professional agency is close to regulated with the intermediate insolvency resolution. Information utility will be their database for adjudicating the authority default. National e-governance service will be provided here. National Company Law Tribunal cases of the companies and limited liability partnerships and the debt recovery tribunals. Bankruptcy and the insolvency and bankruptcy India for regulate the service provided by the IPA and for its transaction, namely the corporate insolvency resolution process and corporate liquidations and the insolvency for the bankruptcy. Now next is the control of the firms during the insolvency. Debtor remain the control in the distress company managed by the resolution procedure. 270 days will be the commencement of the date resolution to the open by bidding process. 120 day will be the compensation. Distress company enter into the direct agreement between the secured creditors and existing owner of this. So insolvency and bankruptcy is the setup, the tracking outcomes of the insolvency and it's a GN Bajpayee committee is there who is working for this. Another issue is dealing with the special circumstances which is involved to the debtor as asset creditor regulated by section 234 235 and it's a nature of the susceptible delay. So section 234 is the central government to enter into the bilateral agreement and the country to resolve the situation of cross border insolvency. So section 235 adjudicating authority which letter on request to the court to competent authority deal with the request for the evidence action in the connection with the insolvency proceeding in the country. Absence of the standards cross border insolvency framework gives rise to the complexities. Extent of the assets held to be the country for insolvency. Priority of the payments will be there. Recognition of the claims in the local creditors. Recognition of enforcement of the local bodies. Insolvency law committee will be there. So insolvency framework can be credited to the adopted in the United Nations Commission for International Law and UNITRAL. National Asset Reconstruction Company Limited and the India Debt Resolution Company Limited. So NPA is the cleanup for the bank book and new related entity is the National Asset Reconstruction Company Limited and the India Debt Resolution Company is the IBC SARFAESI and the Debt Recovery Tribunal and the 28th Asset Reconstruction Company legacy of the NPA. National company is the ARC is the Canara Bank is sponsored for this incorporated for the aggregate acquired state assets. For this will deal with the service company majority on private sector bank will be there incorporated in the September. So it's a 5 year for their term is co-terminus. So asset reconstruction is defined the acquisition of bank financial institution right of interest in any financial assistance for ARC realization. Financial Assistance Company Act is registered with RBI Section 3 of the Securitization, Reconstruction and Financial Assets Information SARFAESI Act is a 2 lakh crore will be the making the lead bank and will lead bank into the Swiss challenge process to invite the ARC bidder better and NARSC and before this declared the preferred bidder. The asset will be acquired and underlying the trust prepared then suggest the proposed restructuring and resolution. Asset acquired resolution will be happen to the RBI framework, then acquisition will be extend of the regulations of RBI and based on the international practice of Malaysia, UK and backed by the government for the credibility and the contingency buffer. Transfer assets of the 15% upfront payment, repayment and acquisition assets, resolving the settlement management and the takeover, restructuring the security, securing the receipts and issuing the ARC. It's a credibility and the backed by the government credibility, then valid 5 year government will charge a guarantee fees and amount is guarantee will be the increase the annually incentive earlier and timely resolution. So this will reconstruct only the asset which is 100% provided to the lenders, not the classified upon fraud. Money policy RBI surplus transfer. Recently RBI is approved the transfer of 99,122 crore surplus to the central government in the service. Other income will be the foreign sources including the profit, load, sale, redemption, foreign securities, gain and loss. Return from the domestic source 33% include the interest, loans, advances, interest, liquidity, liquid adjustment facility. Return from foreign sources include the interest from the foreign currency, interest on the repo, reverse repo. Other income including the profit, loss, redemption of the rupee. RBI expenditures are the 63%. Contingency funds are the it's a second biggest fund designed to meet the contingency exchange rate operation and the monetary policy. Asset development fund include the provision made towards the investment in subsidies associated institution and meet the internal capital expenditure. Asset development fund and contingency fund. Contingency funds are the designed to meet the contingency. Asset development fund is the toward the investment subsidiary and associated institution to meet the internal capital expenditure. Agency charges 15% commission and printing of notes and employee. Now RBI transfer surplus to the government. RBI surplus transfer to the central government are done according to section 47 of allocation surplus profit. Reserve Bank of India amount of surplus to be transferred is revised time and time based committee recommendation of RBI needs. Committee will be the surplus transfer of V. Subramaniam and Usha Thorat and the Malegaon committee of the Bill and Chalan committee. Revise the economic capital framework and the Bima Chalan committee is the amount of the surplus for RBI transfer to the central and this determine the two factors. Realization of the equity like it's a maintaining to the 6.5%. Economic capital is the 20 to 25.5% of the balance sheet will be the rest of the transfer to the government. Lower expenditure of the RBI has been close to the maintain the lower required buffer. Higher income open market operations will be there sizable foreign reserve continuing to the targeting the long-term repo operations. Targeting long-term repo will be used to infuse the cash into the banking system. India Forex Reserve. What are the Forex Reserve? So first is Forex exchange are the 642 billions making the India fourth largest Forex Reserve. Foreign exchange reserve also known the Forex Reserve are the assets held to the reserve the central bank. Foreign currency assets also include the other instrument of bond, treasury bill, gold assets and the special drawing rights. US dollar settlement in international transaction currency assets domination dollar among the currency. So global trade commerce Forex reserves number the purpose. High foreign capital flow reduce the capital inflow. Records of the remittance will be 80 billions. Diaspora major liquidity injection will be there. So exchanges support by the management support the monetary policy, external market shocks and again the investment confidence and the liquidity for meeting the external obligation. Assist the government on the IT obligation help to emerge the regional leaders. Liquidity against the domestic global economic risk will be reduced. NPA will be reduced. Cohesion against the monetary stimulus will be there. So external sector crisis will be reduced and fluctuation will be reduced. As a 600 billion reserve external days obligation enough to cover the 15 months Forex reserve usually account for 1% of due to the net near zero interest rate advanced economy. Larger infrastructure financial needs of India meet the development aspiration of the young demography. Risk of the high opportunity and the fiscal cost of the sterilization liquidity, unused excess cash deposit and development of the needs poverty large youth population show the lack of confidence and the government for the economy and resistance. So soundness of the macroeconomic management will be there. So government is policy monetization of fiscal expansionary policy, and due to the RBI expansionary monetary policy, when the central bank print the money and the increase the lending and net inflow of the fund will be the approach. Change in the price level, inflation, change in the business cycle, increase purchasing power, increase in investment and decrease interest rates, increase the demand of the labor. Now, key concept of the information banking and monetary policy. What are the key component? First is non-performing assets. So special mention account are given there. If there is a asset which is not drawn from the 19 days of that asset, that is the non-performing assets. So it's a 30-day principal interest payment is 30, 30 to 60, then 61 to 90. A special mention account 0 is the 30-day, 1 is the 60 and 2 is the 90-day. So a loan or advance which is principal or interest payment remains overdue for the 90 days principal and interest payment. Okay. So this is classified the NPA or substandard doubtful assets. So substandard assets are the remain NPA for the less than equal to 12 months. Doubtful assets are the category of the 12 months. Loss assets are the debt is continued to the bankable and although they are the sum of salvage recovery. So the capital adequacy ratio is the ratio hold the percentage of total assets of CAR is capital risk is the asset risk. Leverage ratios for this is the borrowing funds is the generate income. The more leverage and the riskier for this start for lenders. Return assets are the profitability derived from the net in the income and the percentage of total assets. Now haircut refer to the lower than the market value placed in the asset being used in the collateral for the loan. Co-lending set up the where the bank and non-bank enter into an arrangement for joint contribution for the credit of priority sector. Provisioning of the coverage ratio like provisioning is to the gross non-performing assets and indicate the extent of fund for this and loss of assets. So performing the regulated entity for the integrated supervision of the monitoring PRISM. PRISM is a web-based system automation system which strengthens the compliance by supervising entity including the bank non-banking financial companies. PRISM functionaries are the cyber security compliance return functionaries, compliance incident functionary will build the remediations and the workflow to the tracking and notification of alerts. Management information system will be also there. Regulatory sandbox is the live testing of the new products and the service in the control test regulation environment. So this permits the certain regulation relaxation limits and the purpose of the testing. Collect the evidence of the benefits risk of the new financial innovation and containing the risk. Foster the responsible innovation financial service. Promote the efficiency and the consumers. Consumer confidence surveys for the RBI quantifiable response from the household regarding to their sentiments on the general economic situation and economic scenario, price level, household income and spending. Inflation expenditure survey households is the RBI for the next round for the capture the inflation. Consumer confidence which provide the useful inputs for the monetary policy. Subjective assessment of the price movement of inflation basket across the 18 country. Payment system and the financial market. What is the microfinance regulation? So microfinance, the banking service unemployed low income individual group features lending the small amounts of the loans, and microfinance largely NGO Bangladesh Grameen Bank and Microfinance Institution 1983. Asset creation, promotion of financing, increase the human resource productivity, poverty alleviation, improvement standard of living, women empowerment. 1 lakh crore will be the paid up capital in this, and the small help banking program is also there. It's a non-deposit taking 5 crore to the funds to the non-banking financial company. 85% net assets will be there minimum for the balance money market in the nature of the qualifying assets. So single using the regulated entity of the RBI. Okay. So definition of the microfinance are the 1,25,000 for the rural, 2 lakh for the urban and semi-urbans are the extended to the for the purpose of the common deficiency additional to the board approved by the policy enumerated for the factor considered assessment. Limits of the household indebtedness like total indebtedness 1,25,000 debt to income ratio will be ensured that the household have paid more than 50% income. Nature of the loans are the collateral free loans, and the collateral free nature of microfinance are there. Earlier loan was 1,25,000 minimum and the 30,000 was there. Now it is 50% loan will be given to the income aggregators, okay, and it shall be withdrawal. Payment periodically will be there, like microfinance borrower are the permitted to repay weekly and the monthly installment. Board approved by the policy provide the flexibility of the repayment, and the microfinance borrower are the required to this. Maximum interest rate, the cost of the 10% will be the loan for the portfolio, 100 crore will be the loan for 12%. Average base rate will be the largest for 2.75%. Board of the interest rates model will be there for relevant factor determining the rates of the interest and the changes of the loans and the advances. So microfinance will also be guided by the fair practice of code and ensure the disclosure transparency. Exemption to non-for-profit companies engage with 50,000 business enterprises, 1,25,000 meeting the cost of the dwelling and this poor person and the not accepting the deposits. Now this engage the providing the collateral free loans to the 1,25,000 and will loans does not exceed 50% will be the household income and having this sizable income 100 crore. Factoring of India. Factoring Regulation Act was passed, and this factoring is a transaction where an entity sale is receivable to the third party, factor of the cost to the third party immediate fund. So important source of the liquidity worldwide, especially MSME facing the liquidity issue. The Factoring Regulation Act provided for the legal framework on the factoring. It allows the four type of entity engage in the factoring business for bank, NBFC, statutory corporation and company. Factoring receivable, factoring business registers RBI due to the condition of factoring principal business. So factoring assets is factoring business constitute 50% of its total assets and income derived from the factoring business and 50% gross income. Liberalize and restrictive provision ensure the strong regulatory mechanism. Amendment Act is enacted. UK Sinha an expert committee with MSME with RBI notifying this significant. Removing the factoring principal Busher criteria, number of the NPMC eligible factoring, streamlining the factoring process and allow the trade receivable discount trades platform registered directly. Central Registered Securitization Asset Construction Act behalf of factor using it will improve the operational efficiency process, promote the trades and reduce the procedural burden. Amend the definition of assignments and factoring businesses receivable to bring them consolence and interest definitions. So gave the regulated making the RBI on the manner of granting certificates, and this will filling the particular transaction central registry trades entity. So this is Factoring of India. Factoring means transaction where the entity sale is receivable to the third party for the immediate fund. So factor like a bank of NBFC is selling their things to the third party. There UK Sinha an expert committee of MSMEs will be there, and bank, NBFC, statutory corporation companies all are eligible for the factoring for the business. Removing the factoring and principal business criteria. Now streamlining the factoring process, allow the trade receivable trades, amend the definition, give the regulation to the factoring also. Now next is account aggregator system launched to the bolster the lending ecosystem. So aggregators are system data sharing system revolutionize the investment in the credit. So it's involved the account aggregator, a financial entity, to consolidate all the financial data of an individual and present a reader friendly manner to analyze the different financial holdings. RBI Act 1934 release the non-banking financial company account for aggregators is directed 2016. With account aggregators special class will be section 45 RBI Act to enable easy sharing of the financial data, provide the inbuilt for the consent of framework. So the significance help the firm to assess the credit worthiness, small business, recommend the wealth management product, individual or tailor of the insurance policy. No other country in the world have developed such type of the system. Real-time cross settlement and the national electronic fund transfer system. So underlying the account aggregator, which is the bank, mutual fund, insurance provider, tax aggregator, flow-based credit, personal finance management, wealth management, and the robo advisor is also there. So RTGS NEFT is the happen to the batches in 30 minutes, minimum 1, maximum no limits are. However, individual bank maybe their own limit will be reached to the NEFT. Nil for the online and the transaction. If fee will be charged on the NEFT done by the bank branch transaction, small amount especially to settle the accounts and between the family and the friends. RTGS is the real time in installations. This is the minimum 2 lakh and maximum no limits. There is the 1 rupees minimum in the NEFT, but RTGS no limits. This is real time instantaneous, and this is per settlement 30 minutes. Nil for online transaction, nil for online transaction. A fee may be charged, and fee may be charged or may not be charged. Okay, in the RTGS, and this is transferring small amount but making the instant transfer of high value amount. RTGS is for the high value amount, and the NEFT is the small amount for the family and friends. RTGS for the goods and for the business. So it's a RTGS NEFT system for the owned operated RBI. Only the bank owned to be the use the both payment system, and if you select the non-bank for approved to the participants. So corporate NABARD is also there. Use Exim Bank. Non-banking will be allotted to the separate individual financial system codes. Current account will be the operated in the Kuber, and settlements account will be there. E-Rupee is the electronic voucher based on the digital payment system, person specific for the purchase for the specific payment system. Developed by the National Payment Corporation of India, UPI platform is a collaboration with the Department of the Financial Service, Ministry of Health and Family Welfare. E-Rupee is the Ministry of Health and Family Welfare and National Payment Corporation of India, UPI. So backed by the existing Indian rupee underlying assets and different from the virtual currency, specific to the purpose, close to the voucher based payment system, prepaid nature, and voucher will be like to the e-gift, and card code will be there. Now Payment Infrastructure Development Fund scheme. This RBI decided to extend the payment infrastructure fund including the street vendors in identifying the part of the street vendor Atmanirbhar Nidhi. Atmanirbhar PM Swanidhi and Atmanirbhar Nidhi is the tier 1, tier 2, and the beneficiary is a subsidized deployment of payment accepting the infrastructure. Tier 2, tier 6, 30 lakh will be there. Framework for payment service operators. So it's a payment and service system 2007 framework place minimum standards for the outstanding payment and settlement related. Person who operate in the authorized payment system. A clearing corporation will be National Payment Corporation of India will be authorized the POS. RBI allowed the POS take the direct management of the centralized payment system. Framework for the offline digital payments. So payment for the settlement system 2017 framework aim to the pushing digital transaction rural and semi-urban area. Offline payment of the 200 rupees transaction 2000 will be there. Bharat Interface Money Unified Payment System. BEAM is the first country adopt the UPI system. So Bharat BEAM is a real-time digital payments. NPCI BEAM application for the virtual payment address, and instant bank to payment bill will be there. Harbinger Innovation for is global hackathon for the smarter digital payment, make the digital payment accessible, underserved, enhance the ease of payment. Harbinger and innovation is the experience, strengthen the digital payment. Card tokenization is the aim to the RBI deferred implementation tokenization of the cards. Online transaction in the 6 months is a card detail about the replace the unique cards, and this allowing the without exploring details. The token is used to be contactless and transaction point of sales, and QR code payment will be there. Reserve Bank of India Digital Payment Index is for the demonstration, rapid adoption, and the deepening of the digital payment across the country. So its March base year is the broad parameters of refer to the infographic of PI supply 15%, demand is 10%, payment enabler 25%, and payment performer. So performer are the 45%. Payment enablers for 25, demands are 10%, and supplies 15%. Now financial market will be. Now we are going to discuss financial market after that.